There is a pervasive and deeply destructive illness that afflicts the modern market participant. It is the compulsion for perpetual action, an insatiable desire to always be in the market, to be clicking buttons, to be doing something. This chronic activity is fueled by a pervasive illusion that in the world of finance, as in so many other fields, action is synonymous with productivity. The amateur trader feels that if he is not constantly trading, he is not working, that he is missing out, that opportunities are slipping through his fingers with every passing moment. He is driven by a fear of standing still. But what if this entire premise is a lie? What if the single most profitable action you could take in your trading account today, this week, or even this month is to do absolutely nothing at all? Richard Wyckoff, a master speculator who dedicated his life not to idle theorizing, but to the pragmatic study of the market's inner workings, came to a profound and transformative conclusion. He observed that the great market operators, the men who moved markets, did not achieve their fortunes through frantic activity. They did so through superior judgment. And superior judgment in the stock market is a quality that cannot be rushed. It is a faculty that requires time, study, and above all, patience. This is a deep dive into the lost teachings of Richard Wyckoff on the subject of patience, not as a passive virtue of the timid, but as a calculated, powerful, and often lethal professional strategy. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. And remember to return to the channel in difficult times when trading isn't going well. To begin to understand the Wyckoffian approach, we must first fundamentally reframe our understanding of patience itself. In the common vernacular, patience is often associated with passivity, with a kind of gentle, hopeful waiting. But in the lexicon of the professional market operator, this could not be further from the truth. Patience, as Wyckoff understood it, is not laziness, nor is it indecision. It is active restraint. It is a conscious, deliberate, and strategic decision to withhold action and to keep one's capital in reserve until the market itself presents an opportunity where the probabilities are overwhelmingly skewed in one's favor. To the Wyckoffian, a position in cash is not a sign of fear or a lack of ideas. It is a tactical position, a state of readiness from which to observe the field of battle and await the moment of maximum advantage. The amateur feels he must always be fighting. The professional knows that most of the battle is won by choosing not to fight at all, but to wait. Wyckoff often drew upon the analogy of a great military general to illustrate this point. Imagine a master strategist standing on a high hill, overlooking the entire battlefield. He sees the full disposition of his own forces and those of his enemy. He observes the terrain, the weather, the supply lines. Does this general, upon seeing the first minor movement from the enemy, immediately commit his entire army to a full frontal assault? Of course not. To do so would be reckless and foolish. Instead, he waits. He watches. He allows the enemy to move, to perhaps overextend their lines, to reveal a weakness in their flank, to fall into a trap of his own design. He is exercising active restraint. He is waiting for the precise moment when a decisive application of force will yield the greatest result with the least amount of risk to his own troops. The amateur trader is the impatient lieutenant on the front line who, seeing a flicker of movement, impulsively charges forward only to be caught in a well-laid ambush. The professional trader is the general on the hill. His patience is his greatest strategic weapon. This perspective is born from a philosophy that views a career in the markets not as a series of sprints, but as a marathon. The entire culture of modern finance promotes a short-term, get-rich-quick mentality. The amateur is searching for that one trade, that one 10-bagger that will change his life overnight. Wyckoff recognized this as the path to certain ruin. His objective was not to strike it rich on a single speculation, but to methodically and relentlessly compound his capital over the course of a multi-decade career. This long-term viewpoint fundamentally alters one's relationship with time and opportunity. When your time frame is your entire professional life, The urgency to act on any single setup evaporates. A missed opportunity today is of little consequence, for the market, in its endless rhythm of ebb and flow, will present thousands of new opportunities in the years to come. The primary objective shifts from profit maximization on any given day to capital preservation over the long run. This philosophy is the psychological bedrock upon which true patience is built. It drains the anxiety and the fear of missing out from the decision-making process, allowing the trader to act only when conditions are truly optimal, not just because he feels the need to be active. The greatest single cause of impatience in a trader is ignorance. He is restless because he does not know what he is waiting for. He sees a chart as a chaotic series of random wiggles, and in the absence of a coherent framework, his decisions become governed by emotion, impulse, and hope. The ultimate antidote to this ignorance, and therefore the true foundation of patience, is Wyckoff's first and most crucial law of the market, the law of cause and effect. This law provides the trader with a logical roadmap of the market's process. It gives him a clear understanding of what he is waiting for and why he must wait for it. The law states that in order for a significant effect, a major trending price move, to occur, there must first be a commensurate cause. This cause, in the Wyckoffian model, is the period of preparation that takes place within a trading range. A trading range is not merely a period where the market is doing nothing. To the contrary, it is the period of the most important and strategic action. It is the time when the composite operator, the great controlling intelligence of the market, is meticulously building his cause. During a period of accumulation, he is carefully and quietly absorbing all of the available supply of a stock. During a period of distribution, he is methodically feeding his large line of stock out to an eager public. This process of building a cause, of accumulating or distributing millions of shares, cannot be rushed. It is a vast logistical undertaking that can take weeks, months, or in some cases, even years to complete. The longer and more extensive the work done within this trading range, the more significant and powerful the subsequent trend or effect will be. To illustrate this, consider the analogy of constructing a great building. The effect one desires is a towering skyscraper. But before a single floor can be built upwards, a vast and deep foundation, the cause, must be laid downwards into the bedrock. One cannot construct a 100-story building on a foundation that was designed for a 2-story house. The attempt would result in a catastrophic collapse. The amateur trader, ignorant of this law, sees the price moving sideways and becomes impatient. He tries to trade within the range, buying and selling on minor fluctuations, essentially attempting to guess which way the building will go while the foundation is still being dug. The professional trader, grounded in the law of cause and effect, understands that his job is not to participate in the messy work of laying the foundation. His job is to observe it. His patience, therefore, becomes a logical and necessary part of his strategy. He has the discipline to stand aside and watch the entire process of cause building unfold. He waits for the unmistakable evidence that the foundation is complete, that the concrete is set, and that the construction of the upward or downward move is now ready to begin. This knowledge is the source of his calm. He is not hoping for a move. He is waiting for the logical conclusion of a process he deeply understands. This understanding is the true source of a professional's unwavering and profoundly profitable patience. Now that we have established the profound philosophy that underpins the Wyckoffian concept of patience, let us transition from the theoretical to the practical. It is one thing to appreciate patience as an abstract ideal. It is another entirely to apply it rigorously in the heat of the moment, when the ticker is flashing and the emotions of greed and fear are vying for control of one's judgment. To do this, we must understand the specific market situations where the application of disciplined restraint is not merely beneficial, but absolutely critical to success. Wyckoff, through his exhaustive study of the market, identified 3 such critical arenas where patience is the deciding factor between professional profit and amateur loss. The first and most foundational of these arenas is the exercise of patience during the market's period of preparation. This is the patience required to sit and watch as a trading range forms and matures. The greatest fortunes in the stock market are not made by chasing moves that are already underway. They are made by correctly identifying the point of termination of a long period of accumulation or distribution, and taking a position just as the new trend is about to begin. This requires the discipline to analyze the slow, often tedious development of the cause before the effect is visible to the world. Wyckoff's codification of the market's phases provides a detailed map for this process. The preparatory phase begins with phase A, which is the period of the initial stopping action. As we have discussed, this is where the preliminary support and the selling climax, or the preliminary supply and the buying climax, occur. This phase is characterized by extreme volatility, high volume, and dramatic price swings. It is the evidence of the collision between the old trend's momentum and the new powerful opposing force. To be impatient in phase A is to commit one of two cardinal sins, either attempting to catch a falling knife by buying into the climax, or attempting to short a stock that is being aggressively accumulated by the strongest hands in the market. Patience in phase A is the wisdom to recognize that while the old trend may have been stopped, the new one has not even begun to form. It is the restraint to simply observe the chaos without participating in it. This is followed by phase B, which is almost always the longest and most psychologically taxing of all the phases. In phase B, the composite operator is actively building the cause. If he is accumulating, he is using this period to absorb the vast majority of the floating supply of a stock. He does this by buying on weakness and selling small amounts on strength to keep the price contained within the trading range, thereby discouraging public interest. The price action during this phase is often choppy, erratic, and seemingly random. It is deliberately designed to be frustrating. It is engineered to wear out anyone who bought during the climax and to bore anyone who is watching the stock. This is where the amateur trader, driven by his need for action, makes his most costly mistakes. He grows tired of waiting for the move to begin and either sells his position for a small loss or a tiny profit, or he abandons the stock altogether in search of something more exciting. Patience in phase B is the fortitude to sit through this prolonged period of strategic monotony, understanding that this dullness is a necessary part of the great operator's campaign. It is the discipline to continue monitoring the stock week after week, knowing that the longer and more thorough the preparation, the more powerful the eventual move will be. Then comes phase C, the phase of the final, decisive test. It is here that the composite operator often engineers his most masterful deception, the spring or the upthrust. A spring is a sharp, deliberate plunge below the established support of the trading range, designed to shake out the last remaining weak holders and to trap breakout sellers on the wrong side of the market. An upthrust is a deceptive surge above the resistance of the range to mislead breakout buyers. To be impatient before phase C is to guarantee that you will be a victim of this trap. You will be the one shaken out at the bottom, or the one buying at the absolute top of the deceptive move. Patience in phase C is the supreme discipline to wait for this test to occur, to watch the trap be sprung upon others, and to then judge the market's response to it. A successful test, where the price quickly reverses and reclaims the trading range, is one of the final and most powerful pieces of evidence that the preparation is complete. Only after the successful completion of these three phases do we enter phase D, where the evidence of the new trend begins to emerge in the form of a sign of strength and a last point of support. And finally, phase E, where the new trend leaves the trading range and begins its public journey. The professional trader, armed with this map, understands that his job is to patiently wait for this entire sequence of events to unfold. His patience is not blind hope. It is the discipline of a scientist waiting for each step of an experiment to be completed before drawing a conclusion. He waits for the proof. Richard Wyckoff was a peerless researcher, a true market scientist who dedicated his life to codifying the universal laws of supply and demand. His method provides a profound framework for patiently observing the market's preparation for a major move. But it is essential to understand that he was not the only master who amassed a great fortune by studying the markets. Figures like Bernard Baruch, Richard Dennis, or Nicholas Darvas each developed their own unique strategies, their own philosophies, and their own specific applications of patience and timing. To give you the broadest possible education, we have created a new channel, Trading Insights. Its mission is to explore the lives, strategies, and defining principles of these other titans of speculation and investment. If Wyckoff's method is your foundational text, consider Trading Insights to be your essential library of market mastery. We invite you to subscribe and explore. The link is in the description of this video. The second critical arena for the application of patience is the moment just before entry. Richard Wyckoff taught that the objective of a professional speculator is not simply to be correct in his directional forecast, but to be correct with the smallest possible amount of risk. This requires the patience to wait for the optimal low-risk entry point, rather than impulsively chasing a move that appears to be getting away from you. This is a battle against one of the most powerful and destructive human emotions in the market, the fear of missing out. Let us imagine that a stock has completed its period of accumulation, and it finally flashes a powerful sign of strength, surging upwards and breaking out of its long-established trading range on high volume. To the amateur, this is the starting gun. A wave of adrenaline hits. He sees the price running and is seized by the terrifying thought that if he does not buy right now, this very second, he will miss the entire move. He abandons all strategy and jumps into the market, buying at a high price at the very peak of the immediate excitement. He has entered at the point of maximum short-term risk. The stock is now extended, vulnerable to any minor profit-taking, and his stop-loss must be placed far away, exposing him to a potentially large loss if the initial breakout falters. The professional, by contrast, views this sign of strength not as a command to act, but as a confirmation of his analysis. It is the final piece of evidence he was waiting for to confirm the bullish case. Now, his patience reaches its most refined form. He willingly allows the initial surge to happen without him, knowing that it is the amateur's chase. He waits for the golden moment, as taught by Wyckoff, the last point of support, or what is sometimes called the backup to the edge of the creek. This is the first pullback or reaction that occurs after the initial breakout. It is the market's natural tendency to test the area of former resistance to see if it will now serve as support. This is the moment of supreme clarity. If this test occurs on light diminished volume, it is the market's final confirmation that the supply has been exhausted and the path is clear. This is the professional's entry point. It is the point where the risk is smallest and most clearly defined. It is a moment of calm after the storm of the breakout. The discipline and patience to forego the excitement of the chase and to wait for this specific, logical, low-risk entry is, more than almost any other single skill, what separates the consistently profitable professional from the boom-and-bust amateur who is forever buying the tops of minor rallies. The third and final arena, and by far the most psychologically difficult, is the exercise of patience within a profitable winning position. This is the discipline required to let your profits run. Richard Wyckoff was adamant on this point. The truly great fortunes are not made from a multitude of small scalped profits. They are made by correctly identifying and riding the one or two great trending moves that the market offers each year. Yet every instinct in human nature works against this objective. There are two great sins that destroy profitability during a trend. The first is fear. A trader may have successfully navigated the trading range, patiently waited for the perfect entry, and now finds himself with a handsome open profit. The stock, which has been advancing steadily, has its first minor natural reaction. The price dips for a day or two. Immediately, the trader is gripped by the fear that his entire profit will evaporate. The desire to protect what he has becomes overwhelming. He sells his position, capturing a small and satisfactory gain, only to watch in agony as the stock resumes its advance and goes on to double or triple from his exit point, He has won a small battle but lost the great war. The second sin is a combination of greed and impatience. A trader is in a profitable position in a stock that is trending higher in an orderly fashion. But he grows bored. The action is not fast enough. He sees another stock that is moving more erratically and appears to offer quicker profits. He sells his perfectly good position to chase the faster action, abandoning a sound campaign for a reckless gamble. He has allowed his need for excitement to overrule his sound judgment. Wyckoff's technique for cultivating this most difficult form of patience was to systematize the process of trend following through the intelligent use of a trailing stop. He taught that once a position is taken and a trend is established, the trailing stop becomes not merely a defensive tool, but an offensive one. In a confirmed uptrend, the stop-loss order is to be moved up and placed just below the low point of each successive significant reaction. This simple mechanical rule accomplishes something profound. It removes the emotional burden of decision-making from the trader. Your job is no longer to anxiously guess where the top of the move will be. Your job is simply to follow your rule and trail the stop. The market itself, and only the market, will eventually take you out of the position when the trend's character finally changes and a reaction low is violated. This technique automates patience. It forces you to sit tight through the minor, meaningless pullbacks and allows you to participate in the entirety of the great, profitable, capital-building trends that are impossible to ride using guesswork and emotion alone. We have journeyed through the foundational philosophy of patience, understanding it not as a passive virtue but as a calculated professional strategy. We have explored the three critical arenas where its application is the deciding factor. The patience to wait through the market's long preparation, the patience to wait for the single moment of lowest risk, and the supreme patience required to ride a winning position to its logical conclusion. But to know the map is not the same as to make the journey. The final and most difficult step in mastering this skill lies not in analyzing the market, but in analyzing ourselves. It requires that we understand and ultimately conquer the powerful internal enemies that conspire to destroy our discipline and sabotage our success. The first and most insidious of these enemies is the trader's own ego. The ego is the part of us that craves to be right, that yearns for the intellectual satisfaction of having correctly predicted the market's next move. This desire is a poison to patience. The ego does not want to wait for the market to provide its evidence. It wants to impose its own opinion on the market. It whispers, "You are smarter than the crowd. You can see this move coming before anyone else. Act now." This leads to the fatal error of taking positions based on anticipation rather than confirmation. The Wyckoff method is a discipline of interpretation, not of prediction. It demands that we subjugate our own personal opinions, no matter how strongly held, to the final impartial verdict of the tape. Patience is the humility to accept that the market's evidence is infinitely more important than our own forecast. The ego finds this humility intolerable. It is the ego that prevents a trader from admitting a mistake, that convinces him to move a stop-loss, and that refuses to wait patiently for a proper setup because it wants the glory of being first. To practice patience, one must first learn to silence the ego and listen only to the market's own story. The second enemy is greed. Greed is the primal, urgent desire for immediate profit. It is the engine of overtrading and the nemesis of sound judgment. Greed corrupts our perception. It makes us see potential trades where none exist. It convinces us to lower our exacting standards, to act on second-rate signals and ambiguous patterns simply because the desire for action has become overwhelming. Richard Wyckoff treated speculation as a serious business, a professional endeavor demanding the same careful study and execution as medicine or law. Greed transforms this business into a casino. It turns the trader into a gambler, pulling the lever on a slot machine hoping for a random jackpot. Wyckoff taught that the professional operator may go for days or even weeks without making a single trade, as he waits for that one single opportunity that meets all of his stringent criteria. Greed finds this inactivity unbearable. It screams that money not in the market is money wasted. This leads to the slow and certain destruction of capital through a death by 1,000 cuts. A series of small, impulsive, and illogical trades that inevitably bleed an account dry. Patience is the understanding that our job is to preserve capital until a true A-grade opportunity presents itself. Greed is the voice that tells us to risk that capital on anything that moves. The third enemy is the most visceral and acute: fear, and specifically its most potent modern variant, the fear of missing out. This is the agonizing feeling that a great opportunity is unfolding right now, and if we do not act this very second, it will be gone forever. The composite operator is a master psychologist, and he understands this emotion better than we do ourselves. He often engineers market action, such as a sudden, explosive sign of strength out of a long trading range, with the specific intent of triggering this very fear in the public. The amateur sees the price lunging upward and is paralyzed by the fear of regret. His disciplined plan to wait for a low-risk entry, such as a last point of support, evaporates in a wave of adrenaline. He chases the price, buying at the peak of the excitement, precisely when the professional who bought months earlier is beginning to think about taking profits. This fear-driven action is a complete abandonment of strategy. Wyckoff's own studies of past market cycles are filled with examples of the public rushing in to buy at the very tops of bull markets. Their actions driven not by logic, but by the unbearable fear of being the only one left behind. Patience is the emotional fortitude to watch a train leave the station. Secure in the knowledge that your disciplined method requires you to wait for a safer and more logical boarding point further down the line. The fourth and final enemy is perhaps the most subtle: boredom. Professional trading, when executed correctly, is often a profoundly boring enterprise. The long, grinding process of building a cause during Phase B of a trading range can last for months. The patient work of monitoring a stock, updating charts, and reading the subtle shifts in volume and price is methodical, not thrilling. The amateur, often drawn to the markets for excitement, finds this monotony intolerable. He craves action, stimulation, and the dopamine hit of placing a trade. When the market offers no legitimate opportunity, the bored trader will invent one. He will manufacture a reason to enter the market simply to alleviate the discomfort of doing nothing. This act transforms his entire endeavor from a calculated business venture into a very expensive form of entertainment. Wyckoff described the ideal operator as a patient, calculating, and unemotional figure, as much a scientist as a speculator. This professional is perfectly content to sit for days, weeks, or months, reading his charts, studying the evidence, and waiting. He understands that he is being paid not for his actions, but for the quality of his decisions, and he knows that the highest quality decisions are born from the quietest moments of observation. How, then, does one combat these powerful, deeply ingrained emotional forces? Richard Wyckoff developed his method not merely as a system for technical analysis, but as a complete psychological framework. Its true genius lies in its ability to impose an external logical structure that acts as a powerful antidote to our own internal emotional impulses. The method itself is the cure for impatience. Its first line of defense is its reliance on clear, objective rules. The Wyckoff method is not based on vague feelings, hot tips, or gut instincts. It is a structured process of evidence gathering. It has clearly defined phases of the market. It has specific events and signals to identify, from a selling climax to a sign of strength to a last point of support. This rule-based framework acts as a powerful brake on impulsive action. You cannot logically justify an entry until the market has provided the necessary evidence according to the model. This forces you to wait. It shifts your job description from that of a frantic predictor to that of a calm and patient identifier of conditions. Secondly, the method forces a profound shift in mental focus from profit to process. The amateur is obsessed with the potential money to be made. The Wyckoff student, by contrast, becomes a market detective. Their primary goal and intellectual reward comes from correctly solving the puzzle of the trading range. They are absorbed in the process of identifying the phases, judging the volume signatures, and deducing the true intentions of the composite operator. When this analytical process becomes the main focus, the desperate, greedy need for a quick profit naturally subsides. Patience becomes a byproduct of a deep and engaging intellectual pursuit. Finally, Wyckoff was a staunch advocate for the meticulous keeping of a trade journal. This is not a tedious chore, but an essential tool for forging self-mastery. The act of writing down the specific evidence-based Wyckoffian reason for every single trade confronts you with your own discipline, or lack thereof. When you later review your losing trades, as you inevitably must, you will almost certainly discover that the most painful losses were the direct result of a violation of the principles of patience. This empirical feedback loop, created by your own hand, is the most powerful teacher of all. It is the crucible in which the habit of patience is finally forged into an unbreakable component of your character as a trader. We have journeyed through the philosophy, the practice, and the psychology of patience. We've established that it is not a passive virtue, but an active, calculated, and immensely profitable professional skill. But how does one truly internalize these lessons and build the unshakable mental fortitude required to wait for weeks, or even months, for the perfect setup? This transformation requires more than just watching a video. It requires a deep and repeated study of the core philosophy. This is the very essence of Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds. The adapted edition by Max Davidson is not merely a book of rules. It is a training manual for the mind. It teaches you to see the market not as a source of random excitement, but as a grand, logical campaign that rewards those with the judgment and patience to understand it. If this video was the diagnosis of the disease of impatience, this book is the lifelong cure. The link can be found in the description. In our final analysis, we have seen that the application of patience is required in three great arenas: the patience to wait through the market's long and often tedious preparation, the patience to wait for the single fleeting moment of lowest possible risk before entry, and the most difficult patience of all, the patience to sit tight and allow a winning position to grow to its full logical potential. The stock market, at its core, is a simple mechanism. It is a grand device for transferring wealth from the perpetually active to the strategically patient. Your goal as a developing professional is not to trade frequently, but to trade exceptionally well. And to trade well almost always means long periods of intense, focused observation, followed by brief and decisive moments of action. You must learn to embrace the process of waiting, to find satisfaction in the quiet study and the gathering of evidence, for it is in these moments, far from the noise and the frenzy, that the decisions which build great fortunes are made. The market truly and generously pays you to wait.